Today, we're taking a look at the investment case for a company called Ayvens. Now, you might not know the name, but it was born from a mega merger to become the new global leader in vehicle leasing.
So, where did this company even come from? Well, back in 2023, two absolute giants in the industry, ALD Automotive and LeasePlan, came together to create this new titan, Ayvens. And let's be clear, this wasn't just a small deal. It was a move to create the undisputed king of the hill in this space. And what does being king of the hill actually look like? Well, it looks like this. A global fleet of 3.4 million vehicles. Just let that number sink in. That is a truly massive operation, putting them way, way ahead of any of their competitors. But, as any investor knows, bigger scale can come with bigger challenges. And that really brings us to the central question for us today. Is bigger actually better here? Is Ayvens a compelling investment right now? Okay, let's dive in. To figure that out, we've got to pop the hood and understand how this business actually makes money. The whole Ayvens model really boils down to three core ways they generate profit over the life of every single car. It's this really calculated dance of asset management. So first, they make money on the financing of the lease itself. Simple enough. Second, they make a profit from all the bundled services. Think maintenance, insurance, the whole shebang. And then finally, they either make a profit, or sometimes a loss, when they sell that car on the used market a few years down the road.
Now, that last step, selling the used car, that's where things get really interesting, because it introduces the single biggest risk in this entire business model. It's called residual value risk. It's the danger that the price they get for that used car is way less than what they guessed it would be worth years earlier.
I mean, think about that. A huge chunk of the profit from a contract they signed today is totally dependent on the wild, unpredictable used car market 3 or 4 years from now. This is the central tension of the whole business, and it's a point you have to keep in mind.
So with this huge risk just hanging over the business, why are some investors so optimistic? What are they seeing? Well, that brings us to the bull case.
The bull case really starts with the idea that Ayvens is surfing on several powerful waves of change. You've got the big shift away from owning a car to just using one. And maybe even more important, you've got the massive transition to electric vehicles. For a regular person or a company, buying an expensive EV when the tech is changing so fast is a huge risk. But leasing it? Yeah, that makes the decision a whole lot easier.
But if you really ask a bull what the main event is, they'll point you to this number, 440 million euros. That's the amount in annual cost savings, the synergies that management is promising to deliver by 2026, just by combining the two old companies. For investors, this is the real, tangible prize.
But of course, there's always another side to the story. The bears, the skeptics. They're looking at this whole thing and they see two massive risks that could completely derail the optimistic case.
The first one is just pure execution risk. I mean, can they actually pull off this massive merger? We're talking about mashing together different IT systems, different company cultures, different ways of doing things across dozens of countries. If they stumble here, that promised 440 million euros in savings, it could just vanish.
And the second, and maybe even bigger risk, brings us right back to that residual value problem, but with a modern electric twist: EVs. As this quote lays out, the future value of an electric car is a giant question mark. You've got new battery tech coming out, worries about how long the batteries last, and car makers starting price wars. It all means the value of a used EV could just fall off a cliff. So right here you can see the battle lines being drawn for investors. The bull case is a pretty simple story of size, savings, and big trends. The bear case is all about the huge risks of the merger itself and the completely uncharted territory of what used EVs are going to be worth. So with this tug-of-war happening, how is the stock market pricing it all? What does Wall Street think? Let's take a look at the investor's scorecard.
And this one number, it tells you almost everything you need to know about how the market feels right now. The stock is trading at a price-to-book ratio of about 0.7. So, in simple terms, the market is valuing Ayvens' entire fleet of cars at a 30% discount to what the company itself says they're worth on its books. That is a huge statement.
In short, investors are super skeptical. A valuation like this, it basically screams that the market thinks there's a real chance the company is going to have to write down the value of its cars in the future, especially those EVs, or that it just won't be able to make good enough profits on them.
But look, management is fighting back against this skepticism with a very clear plan they're calling Power Up 2026.
This table is basically their public promise to all investors. They want you to hold them to it. They're telling you to track their profitability, their efficiency, and of course, whether they hit that all-important 440 million euro synergy number. This is the report card they'll be graded on.
And so, this leaves us with the ultimate question for any potential investor. Is the market right? Is today's discounted price a fair reflection of some very real risks, or is this a rare opportunity to invest in a new global leader at a moment of maximum doubt, just before the rest of the market catches on?